Good morning from Los Angeles. How's everyone doing? Welcome to Trading with Sergio. It was an interesting weekend, correct? A lot of guesses on the internet. What's going to happen to the market? They downgraded the Treasury bond rating. Well, the opening was quite interesting. But after that, it's turning out to be a nothing burger. Market's about to go green, it looks like. Stocks don't care. That's the bottom line. But I have a few things to say about the downgrade and what the bonds are doing versus what stocks are doing. Now, let me go through the schedule real quick. Every Monday, Trading with Sergio, 10 a.m. Pacific, 1 p.m. Eastern. Every Friday, Power Hour, 10 a.m. Pacific, 1 p.m. Eastern. And every Wednesday, for members only, we do a members only live, probably around 3 to 5 p.m., somewhere in that range, depending on my schedule and doing other things. Market was strong on Friday, very strong close. Bonds have been telling a different story all along anyway. Bonds don't listen to anybody. Bonds just are too big to manufacture results on, like we can do on the stocks side. Interest rates have been going up while the Trump administration is pounding the table for lower interest rates, and the Fed is saying, nope, we're going to stay put. We're data dependent. I think the Fed is correct on this one. I blame them always for being behind the curve. They were behind the curve raising rates after pumping 7-8 trillion into the economy due to COVID, which was a black swan event, really. But the rates have been going up while the Fed has been trying to lower rates. So Fed has lowered rates since last September 18th, three times, one at 50 basis point, one at 25, one another 25. So Fed has cut the rates, the Fed funds rate, three times to the tune of 100 basis points. But the bond market today, specifically, after the downgrade, the 20 and the 30-year went about 5%. Now, there used to be a very strong correlation between bonds and stocks. That seems like it's out of the window now, when nobody cares. The reason for that is, people are used to stocks going up 25% 2 years in a row. Things don't work out like that. If you look at the history, it's about 9 to 11%, including reinvesting the dividends. However, bonds being risk-free, let's say, okay, if you do invest in a U.S. 10-year, 5-year, 2-year note, 20-year bond, 30-year bond, right? That's risk-free. You're going to get your money back. In stocks, there is no guarantee you're going to get your money back. You may lose money, you may make money. However, the correlation that existed for a long, long periods of time, correlation meaning when interest rates went up, stock market went down. When interest rates went down, stock market went up. Over the past few months, the interest rates actually have been ticking up. If you look at the 20-year and 30-year, and today was the culmination of all that with the downgrade over the weekend. And downgrade for stocks is turning out to be a nothing burger. For bonds, bonds are, I think they bottomed right about 7:30 this morning, and then they've been rallying, meaning yields are coming down. So we're back under 5% on the 30 and the 20-year. But bonds are not supposed to move like that, right? They're not like stocks. Bonds move a lot slower. Figure bonds is a huge tanker, oil tanker. It can't maneuver that fast because it's just that big. There is hundreds of trillions of dollars of bonds out there. If you consider all the bonds issued by nations' treasuries, then add to that corporate bonds from all the way Apples all the way down to junk bonds, you have many different tranches of bonds, right? Duration, quality. Then you have municipal bonds. I mean, just the trillions and trillions and hundreds of trillions of dollars in market. The reason we have so many bonds out there is because we are a borrower and spender society, and the world has become like that. So if you look at bond rates around the world, they're all spiking up. Why is that happening? Well, Japan is spiking up. Japan's 30-year bond just broke 3.75%, while Japan had negative interest rates for 20 years because they were in a deflationary period and they tried to get themselves out. Now it seems like, well, Japan's actually prime minister over the weekend said, we can't do much about this. We're worse than Greece. You guys can go Google it. And he literally said that. Greece meaning, we know what kind of troubles Greece has been in with high inflation, in higher interest rates, junk bonds, basically. I've said that before as well, that when the only country, though, that can control the situation is the U.S. Why is that? One, the U.S. dollar is the reserve currency of the world. Every transaction pretty much goes through dollars. Number two, we are practically the only country on the planet that we can, they used to call it printing money. We don't print money anymore because it's just too costly. All the Fed does and the Treasury does is add zeros to the ledger. Why do we do that? Well, we do that because we have $2 trillion a year in national debt, national deficits. So how does that work? It's not trade deficit. This is national deficit. How does that work out? It works out in a way that we, our budget, right, is our income to the Treasury through obviously W-2s, Social Security taxes, and income taxes, capital gains taxes is about $5 trillion. We have to run the country with $5 trillion. Well, what we do is our budget is $7 trillion. So we have a $2 trillion deficit, and that has to get made up somehow. How does that get made up? Well, we issue bonds, we issue IOUs, and these IOUs are bought by foreigners, such as Japan is the number one holder of U.S. Treasuries. Number two has become UK now. They surpassed China. China is continuously selling bonds and buying gold. So when you have that much issuance of these new bonds, right, what happens? Well, the buyers of these bonds, the new buyers of these bonds, are going to demand a higher return. That's why the interest rates are going up. The other thing the U.S. bond market has been saying is that the tariffs, although they may be gone now, we don't know, because we have July 2nd or 4th coming up, which is 90 days after Liberation Day of April 2nd, the bond market's forecasting higher inflation. That's why the interest rate's going up. So there's twofold. There's too much issuance coming up. The U.S. has to refinance literally $9 trillion worth of bonds that are maturing in different maturities this year. We have 7 months that we have to refinance that. We cannot say to the bondholders, well, first we'll have to pay them back, and then if the IOU holders decide to reinvest to the same degree, to a higher degree, whatever it is, they will have to come buy those bonds. Well, the Fed auction happens literally on a daily basis, literally, billions and billions of dollars. So what's going to happen is that the buyers of these new issuances, they're going to require higher rates. That's bond market sniffing that, and then the rates are going up. Although the administration is quite adamant about lower interest rates. Well, I do understand that. The reason for that is interest cost. So all these IOUs that we have put out there at $37 trillion at the moment, and it's going up by $1 trillion every 100 days. The U.S. national debt is. This is not political, regardless of who the administration is or what it is. We spend more than we take in. And to make up that debt deficit, we have to issue IOUs. That's the only way we can do it. So the bond market's sniffing this and raising rates. The administration wants lower rates. Fed goes, no, we can't do that because due to tariffs, even on a lag basis, interest rates may go up. Okay. So, but the stock market is not listening to it at all. Like, it's not concerned at all. In fact, there was some tweets over the weekend that I was going through my X feed. They go, some people were saying crash. Some people were saying it's going to be a nothing burger. It's turning out to be a nothing burger for stocks. Bonds are moving widely. My thesis was that we are going to go in a stagflationary period. That's stagnant inflation. I mean, that's stagnant economy with high inflation or more than expected average high inflation. And I still hold true to that, but the stock market is not paying attention. So that's a different story. You have to trade what's in front of you. In a stagflationary period, we had this type of period in the 70s. And what happens is that there is no cure for stagflation. There is a cure for inflation. You raise rates, you kill inflation. There is a cure for deflation. You lower rates, you try to cure it that way. Stagflation, there is no cure or antidote for the fact that if you have a stagnant economy slowing down, you have to lower rates. If you lower rates, inflation, on the other hand, the other half of the stagflation word, inflation, is going to pick up. So you're caught in a box now. The Fed is caught in a box. They don't want to lower rates. Even if they did, the bond market's raising rates anyway. So since September 18th, if you guys look at a chart of a 20-year bond, 30-year bond on the long end of the curve, while the Fed has lowered the rates 100 basis points, the market itself has raised the rates by over 100 basis points. So it's very rare that happens. I don't recall in my career of 30 years seeing that before. So we have two completely now uncorrelated asset classes. We have bonds and we have stocks. Stocks are saying everything is fine, economy is fine. Well, if the economy is fine, that means the rates don't have to go down. While the Trump administration is saying, no, we have to lower rates. Well, I disagree with that. If you do lower rates now, inflation is going to, it's going to be fuel to the inflation fire. We don't want that. If we do that, then all asset classes are going to take off again, right? Which is nothing wrong with that. You know, people want higher stocks, great. But what is happening is that the bond market's not agreeing with any of that. So at some point, the stock market has to pay attention to the bond market, because in stocks, you can invest your money in stocks. You have risk. In bonds, you can collect 5% on a 20-year bond, risk-free, knowing you're going to get your money back in 20 years and collect 5%. In stocks, you don't have that. You may get higher rates, you may get lower returns. So at some point, risk-free asset classes such as bonds, notes, bills are a better investment than stocks at some point. And stocks have to pay attention to that because it's competition, right? How do money managers allocate assets? Do they go invest in bonds? If the bonds are 5% risk-free, if I can collect 5%, why do I have to deal with stocks that can move up and down 20, 30% within days, literally? So granted, over long periods of time, stocks do well. But, I had talked about this in a previous show, calling this is the lost decade. If you guys look at the SPX, on that pullback to 4,800, we were back to where we were in 2021. Well, now we're back up again. But on the bond market, it's definitely the lost decade. And I'll put up the interest rate charts and we'll talk about that when I put those up. But so at the moment, stocks don't care. Stocks are forecasting a strong economy and earnings are going to be there. And the Mag 7 earnings came out. All the S&P 500 earnings came out. They were pretty good for this quarter. The effect of the tariffs with a lag will show itself up on the next quarter. We'll see how that works out. So we're completely decoupled now. Bonds are saying higher inflation. Stocks are saying lower inflation, strong economy. Well, in that sense, bonds are saying, well, then rates don't have to go down. We don't need to lower the rates. So you guys, hopefully I was able to clearly make you guys understand what's happening, right, in the macro picture. Now, on a day trading or swing trading, scalping, position trading, does that matter? Macro matter? It should matter. You should pay attention to it. But if you're day trading, I don't think you care. The next 5 minutes is the most important thing in your life at the moment. So yeah, that's the picture. And what I'm going to do is, I'll go through some charts. I'll go through the positions. I had a TLT position, as many of you know. I was in the opinion that interest rates are going to go down, because when the market sold off 20%, that could have in itself put us in a recession or a slowdown. Well, when you go in a slowdown, bond rates go down, interest rates go down. That did not happen. On top of that, we had the downgrade. Now, this downgrade, the fact that it happened on a Friday, obviously it affected the opening today, but then the opening tick was the low tick. Since then, we're just walking the market up. We may even be green while I'm talking to you guys. So the downgrade, it's been done before 2 times by the other 2 agencies, Fitch and S&P. S&P was first. That was, I think, 2011. And the effect of that was much more severe than what we experienced today. Market went down literally 20%, but we had many, many different things going on. We were coming out of the GFC. The dollar situation was different. It was much different situation. So then we had another one by Fitch, which is the second rating agency. They did that in 2023. The day after that, market was down 1.4%. And last but not least, Moody's did it on Friday after the market closed, saying that we cannot, the economy cannot continue forward with all this debt. And I started the channel to talk about that, right? There has to be something done about this. Could we even do something about it, right? Because it's so out of control. 37 trillion in debt, right? 1.2 trillion in interest cost alone. $1.2 trillion, which is literally the cost of Social Security. It's 50% more than our defense budget. We're literally putting that money on fire. We have to pay interest. We have all these IOUs. Now we have all these IOUs maturing, about 8 to 9 trillion in 2025. Those are going to get replaced. Well, all those IOUs were issued when rates were very, very low. We were in the ZIRP period, zero interest rate policy period. Well, now they're going to get refinanced. Once they get refinanced, we have to put a higher coupon on these bonds. Well, 30 years and 20 year are 5%. Now we have the 5% versus an average of 3.5%. That's going to add to the $1.2 trillion in interest costs. So this year, the forecast is $1.5 trillion in interest costs. And every year, this is going to go up as long as the national debt keeps moving $1 trillion higher every 100 days. So you guys see what's happening here, right? So this fire is fueling itself now. And every year, we keep tacking on a couple of $1 trillion into the national debt. We print, we inflate. Inflation keeps going on. It's not dying. The interest cost is getting out of control, right? So we have to somehow control that. And Moody's saying the exact same thing. Moody's says, look, this is out of control. This is not manageable. At some point, this is going to hurt badly. But stocks don't care at the moment. But one day, they will care. When will that be? I don't know. So what we have here is Fed's in a box. They're in a dilemma. The administration wants lower rates. I disagree. I don't think we need lower rates. I think the market's doing what it needs to do. Fed cannot control the bond market. Fed cannot control the global bond market. Fed can control maybe locally, short-term discount rate, Fed funds rate, things like that. But they don't see a necessity to cut rates. And more importantly, to me, is what are you guys seeing out there? Is inflation dead? Are you guys still paying higher prices? Are we going to pay higher prices because of these tariffs? I don't know, because that's been like a musical chair kind of a game. So yeah, that's the picture. That's the macro in general. And when Moody's cut it, of course, futures sold off. This morning they opened on their butts, down about over 1.125% or 1.1%. And then since then, they just brought everything back. As if it's a nothing burger. And a lot of people who said it's going to be a nothing burger, they were correct. Well, at the moment, we haven't closed yet. We have a couple hours to go. So, I'm wondering when the stock market's going to pay attention to the bond market. At the moment, it's not paying any attention to it. Higher interest rates, by the way, are bad for smaller companies. Big companies can deal with it. They have pricing power. They have staying power, all the Mag 7s, most of the S&P 500 companies. But smaller companies in the Russell 2000, they need money to function. And at 5%, because they have to pay a premium over 5, they can't borrow at Treasury rates are 6, 7%. They're going to struggle. So smaller, mid-sized to small companies, public or not, are going to have issues going forward. That's without the economy slow down. If the economy slows down, that's double whammy. I trimmed my TLT position because my thesis is proven incorrect. I had a beautiful profit on it. I trimmed some with some profits. Today I trimmed some with losses. I'll see where the picture is at. But, interest rates going up, 20, 30-year interest rates going over 5% is going to increase mortgage rates for sure. It's going to increase car loan rates. It's going to increase a lot of the interest rates that we deal with, such as credit card rates and things like that. So we'll see. We'll see where things are going to be. And the other thing I'm going to do is I'm going to put the link up of the live stream. If anybody wants to show their pretty face, you're more than welcome to do so. And here's that link. All right, let's see what's going on. Adele, good morning. Techie B, good morning. Ernesto, good morning. Afternoon, seems like a nothing burger. Yep, exactly. Vic, good morning. Traveler, good morning. Good morning, Vic G. Manny P, good morning. So that's that. Let's go to the positions real quick. I didn't do much, actually. I have some puts. They're okay. But let's go to the positions. Hopefully you guys can see this because on Power Hour I messed it up. So here's the positions. It looks like S&P is green now. All right, so where are we? I have 4,000 shares of EVgo. I have average cost 372, 378 now, down a few pennies. I have 30 puts on Pony AI, $15 put, June expiration, June 20th. My average cost about, it says 3, but I don't think it's 3 because I sold some calls. I sold some puts against it on Friday, about 20 cents. They expired, worthless. Whatever they are, they're pretty underwater a little bit. I have some SPX put credit spreads expiring in June. TLT, I had 25 lots. Now I'm down to 10 lots. No need to fight against the trend. That was a beautiful green position when TLT rallied to 91. After I put the trade on, now we're back down to 85. And last but not least, I have 3,500 shares of WeRide, average cost 750. We're at 855. I have sold some June 7.5 puts over $1.07. They're about 75 cents. And I have covered calls against it. 15 of the June 10 calls I have sold at $1.10. They're $1.10. Earnings are coming out on that. WeRide and Pony AI are both Chinese AV companies, autonomous vehicle companies, and one has gone from 4 to 17. The other one is still meandering around 6.5 to 9.5 range. It's kind of a pair trade. We'll see where that goes. Let's see. So out of the 3,500 shares, I'm covered with 15 of the 10 calls and 20 of the 12.5 calls. I have 32 days to go for June expiration. They're all June, the puts and the calls. I want to sell more puts. I want to own more shares around the lows, which is about 6.5 or 6.25 range. I tried to sell more puts this morning. They never got up there, so It didn't happen because stock opened at 812. Now we're at 856.57. And June calls. If I get called away, if I'm put more, I'll be glad to take some shares down. If I get called away at 10 and 12 and a half, it'll be about a 55% trade because I own the underlying shares at 7.5. So those are the positions. And let's go through some charts. Yeah, S&P is up. Is it? Yep, it's up. It's up 7 handles. And so today's MVC actually is making, let's see. Yep, it's green for sure. I may do a little 0 DTE trade here, but we'll see. We'll see on this next rally up. If we do make a new high, I may do a 59.60, 59.50, put debit spread, put a couple of bucks up, risk 1,000, try to make a few bucks. But we'll see where that goes. But before I do that, let's go to the charts. This is SPX. All right, so this is SPX. We don't want the 2 minute. We want the 1 year, 1 day. We had a V bottom. We keep rallying. We're coming into a little bit of resistance, but we have gaps left. We have a breakaway gap. We have a extension gap. So yeah, it was a V bottom. We just turned and ripping higher. We have a little bit of an uptrend. It could be a mean reversion, kind of a pullback here, but nothing major. So this is TLT. So TLT is 20-year bond ETF. And we have rallied quite a bit. The low was 84, 83. We're 85.71. Bonds don't move like that, by the way. So at least I waited for the rally to trim today. And we'll see. We held 85, it looks like. The reason I did the bond trade is, look, I did it with $2.75 credit. So I'm short the 85 puts going out to March 2026. I am long the 95 calls and I'm short the 110 calls. So I did it with 275 credit. And so that will put me in next March, if I hold it that long, obviously. The idea wasn't that I know I'm not going to hold it that long. But the reason I did the trade with 85s is going back to 2002, 2003, TLT has been as low as 81. And we're at 85. So I was like, okay, I don't mind buying TLT at 5%, 20 year. Well, it seems like we went through that today, but we're just going back under it. The trade still stands. I trimmed it, obviously, because when things are going against you, you manage risk and you trim. You don't keep doubling up. And that's TLT 10 year. But let's go to 1 year. Well, so this is when September 18th, right here. Right here. Let me see. Of last year. 12 September. Right here. September 18, actually. So September 18, this is right here. TLT was 101, 101.64. That's when the Fed cut the rates. And since then, they cut it 3 times. What is the bond market? So this is an inverse indicator, by the way. So if TLT is going down, that means interest rates are going up. If TLT is going up, that means interest rates are going down. What has TLT done? 101 to 85. Okay. So TLT, which is 20-year bond, inverse ETF, they're not believing it. They're not buying any of it. So they're raising rates, actually. Triple Qs, same thing. Open lower, going higher. Nothing burger, more than nothing burger, it's up. Although Mag 7 is kind of acting weak today, but the rest of the stocks are catching up. Apple still down for the day. Microsoft is the strongest one of the group now. It used to be the weakest one of the group. Now it's the strongest one of the group. Pretty close to an all-time high. 468 is all-time high. We're at 458. Meta the two strongest Mag 7 stocks, and Netflix, obviously. Netflix is all-time high, 1196. What a rally from kissing the 200 EMA or tagging it, about 300-point rally. The weakest one at the moment seems like it's Google. Google, yeah, that's the weakest one, it looks like. Nvidia was red all day. Let's see if it's still red. Yep, still down a few pennies. Tesla was down. I think it's still down. Yeah, Tesla's still down $8. But Tesla had a rally. All these stocks need to get bought on pullbacks. I could go through, some of the quantum stocks are moving for some reason. Well, they moved on Friday. They're moving today. This is one, QMCO. I may buy some of these shares. Just a big old volume came in. The HFTs attacked it. And here's a 1-day, 2-minute chart. Started in the morning, 1042 low, 1435 high. Consolidating before the next move up. I may buy some shares. There's no options on this. There are a lot of good looking charts out there now. Hood is one, obviously. Robinhood. It's 2-minute, but let's look at the daily. It has turned green, obviously, for the day. Right there. Palantir. It may be still red. I don't know. So our members made some money on UNH. We'll talk about that in a second. Yeah, Palantir just looks like building a bull flag. UNH, we know what's going on there, right? Look at that fall. Actually, only one of our members, I think, took advantage of that. Did some put credit spreads. And so yeah, that's where we are. And some other stocks that I'm looking at, actually the ones I'm involved in, let's look at those. This is Pony AI. Right there. What a rally, right? $4 to $22. And then I have puts now. But then it's a pair trade with WeRide. Exact same thing that they do. They're both Chinese autonomous vehicle companies. Well, either this one's going to go up or the other one's going to go down, or it's to meet somewhere in between. We'll see how it goes. EVgo. The ones I'm involved in. That's all. So earnings were there. Decent looking chart. Moving averages are catching up. I like EVgo quite a bit. The other ones, some of the other ones I'm looking at, Archer Aviation. Pretty big down day, but new high was made up to 14. Yeah, that needs to get bought. SoFi, same thing. Consolidating. Let's see. Another quantum stock, ARQQ, ARKit, quantum. I like these types of charts. And I mean, some of these are not worth the paper it's printed on, but charts are charts. You can't have a bias about what the company is. You just look at the chart and go with it. Let's see. Carvana hanging in there. New high. I mean, what else is there? We have some ripper rallies. It's amazing. Gold sold off, although after the downgrade and bond situation, it's kind of right at the 50 EMA. Probably should be bought. I'm not going to buy gold GLD. I'm going to trade NUGT, which is Nugget, which is the 2x ETF of gold miners. Hims and hers. A lot of people interested in that. Look at that rally, 25 to 65. I mean, fortunes are being made, peoples. Bitcoin. This is IBIT, which is BlackRock Bitcoin ETF. That's another thing that has decoupled. Bitcoin is not paying any attention to what's going on. Actually, the downgrade of the bonds is positive for Bitcoin. I've been DCAing every Monday. I bought more, averaging up, averaging down. MicroStrategy up 11, consolidating after a nice rally from 250 to 420. MSTU is the one we trade, which is the 2x ETF of MicroStrategy. And what else? So I was able to buy some stocks in my long-term account. Kava was one, Nike another one. Unity Software and a couple other ones. Soxel was one. Robin I bought and sold, which is the 2x ETF of Hood. What else is going on that's catching my eye? I'm just going through my watch list. If you have any questions, please put it up. If you're going to come up, please put it up. Let's see. Yeah, that's about it for now. Let me go to the front screen. Hopefully this time I didn't mess it up and you guys see it. Okay. Okay, Jason, crowd, Amazon, yen. Okay, let's take a look. Crowdsource. Yeah, nice chart, double bottom. About to make new ATH, all-time high. Consolidating, next leg up. I don't know what the 3-year looks like, but let's take a look. Yeah. Well, we'll find out when we get there. We're there. 455, 446, 10 points from an all-time high. Decent looking chart. Amazon. It's Amazon. One of the laggards in Max 7 looks okay. Earnings are okay. Most Max 7 earnings were okay, with the exception of Google was good. It didn't go up. And Yin is the ETF of Chinese companies. 3x ETF. It's hanging in there. I mean, you know, let's see how it goes. Baba's earnings were not that good. Alibaba. Billy. Yeah, I mean, you know, they're in the middle, like in the middle of nowhere almost, to me, to be honestly. I mean, looking at them now. Yeah, I would not mess with those at the moment. If you have any questions, you guys going to show up, please put it up on the chat. Let's go. Let's see. Is it a good play? No, not at all. It goes up, let it go away. Let it get taken away. If your cost is 7.5 like mine, and you took in over $1 for the calls, that's 11 for 30 days. 7.5 to 11 change is 4 points. That's like 60% almost, 55%. I mean, if you don't like 55% in a month, then sorry, I don't know what else to say. That's why you sell puts. I had sold the 5s. Now I'm selling the 7.5 puts. I want to get assigned either way or get called away. Either way, it's a 55, 60% trade if you look at the 12.5s and the 10s, the cover calls. I would not buy those back. They're still very high IV. Earnings are coming out in a couple days. Not that it's going to matter that much. You're going to lower your cost. You bought a stock at 7.5. You sold the calls at $1.10. You're going to lower your cost almost like 18% in a month. I don't see any reason to buy anything back. So yeah. All right, let's take a look at the market one more time. I may buy some of those put credit spreads, 0 DTE ones. Monitor. Yeah, let's see where they are at. So on SPX, what time is it? 10:40. Yeah, we got a couple hours. Let's see what we can do with those. Let's see what we can do. MVC today is 59.55. So we're now 59.63. So if we're going to go to MVC, 59.60, 59.50 would be the ones I would do. So there's 59.60, 59.50. They're at $3. So if I buy 5, I'm risking 1,500 to the close to make 7. Yeah, let's buy a couple of those. Let's see. Instead of 5. My auto's at 5. Let's buy 3. Let's spend $1,000. 315. 59.60. 59.50. Yeah, let's buy 3 of those. Okay, we did that. We'll add a couple more if we rally here a little bit more, which looks like we are. Yeah, let's buy a couple more. And we'll see. We're at $3. Let's look at the chart real quick. So when I'm trading those, I'm looking at the short-term charts. Oh, we got up to 59.68. Wow, okay. Okie dokie. So we bought the 60.50. We're hoping it settles around 59.50. If it does, that's max gain. Max loss is $3 that I put up. If we do rally back up here, I will buy a couple more, about 59.65 range. Yeah, 59.68 is too far from MVC. Okay. What do we pay for those? We paid $310, $315. Okay. Okie dokie. Let's see if we can buy a couple more if we do rally. Or we'll sell those and make a few $100. So that's where we are, folks. So when you do these 0 DTs, now you got to watch it, because they move so fast on SPX. They literally like lightning fast. I mean, they move, these debit spreads move fast. And see if we can make a few $100. If we can't, we can't. All righty. Any other questions? Anybody else? Nobody wants to show up? I put the link up. I put the link up. Okie dokie. Let's see where it's at. So we want to drop within the next 2 hours and 15 minutes to 59.50 for a max gain, which is not too far. Basically go to unchanged kind of a level. I mean, this is 2 minutes. This is the open, huge gap down, 58.95 range. And that was that massive rally, sideways breakout, sideways breakout, sideways. It's either going to be a breakout or a breakdown here for about 50, a couple of handles. So we bought some of those. Where are we? 59.62. Are we going to? breakdown, or are we going to rally at the end of the day? No, when I say breakdown, we just want like 10 handles. We don't want much for it to get the max gain. Well, we bought some, so we'll see. We shall see. This is live trading, folks. We're even on it at the moment. Obviously, there's going to be time decay. If it closes here, they're going to expire worthless, right? So when you guys are trading these 0 DTs, please figure that part out. There's time decay. There's theta decay, as they call it. Or theta is time decay. So you guys understand. What else? Okay, where are we? All right, let's see. What's happening? Just going sideways. Okay. Yeah, just market doesn't want to go down. Just does not want to go down. Strong. Very strong. Okay. Let's see if we can make a few $100. We're at 345. We can sell them for 345. 350. Made $100. Should we take our $100? We're back to $60. Yeah, if we do drop to 59.50, we can probably sell these at 5, make a few $100. 355. What are we trying to make? A couple $100? Is that what we're trying to do? Just bored, that's all. Or should we go for a max gain? Go for it. 360. 375. 380. Do we go for it? Let's take a $200. 390. 395. Let's sell them at 4. That'll be $250 for credit. Let's see. We are... Yeah, we just need a couple of more down ticks for 4. Nope. Nope. Not yet. Next bar, maybe. If MACD goes under 0, I'll cancel. Let's go for a max gain. We need 59.55 for 4. Yeah, market's just too strong. Just doesn't want to go down. Next bar. Let's do it. Like watching paint dry. Oh, we may get it. Two more down ticks we need. Yep, just got done. 250 bucks. Not bad. I like doing these little put credit spreads or call credit spreads. Imagine if you did a call credit spread. That was 250 bucks, folks. I think we're going to end the live stream on a positive note, unless some of you want to come on. Trade, monitor, let's see. Bottom at 315, sold them at 4, 85 cents times 3, 240, 255. Not bad. 4 or 5 minutes of work. Actually, I enjoy doing these once in a while. You know, as long as I know what MVC's at. I mean, most likely we're going to end up at 59.55. That's why I sold them at 4. If MVC was much lower, I would have held it. MVC's most valuable contract. Where do I get that on Quant Data? Show average fill prices. So yeah, this is my trim on TLT. So average buy was, so we did 3. So we had bought the 59.60 puts at 620, sold them at 765. And we had bought so we made $1.45 on those. That's how fast they move. And I had sold the 59.50 puts at 305, bought those back at 365, so lost 60 cents there. So 625, 765, 620, 765, 145, and lost 60 cents, exactly 85 cents. 85 cents times 3 after costs is about 250 bucks. And sure enough, we sold it right exactly where we needed to sell it because we bounced back. Yeah, I need to find out where MVC is. I think it's either 59.55 or 59.60. That's where we're at. Wait for this hour to finish. Okay. Why would I? I already took the profit. Why you didn't do just puts, no spreads? Why would I? Why would I? I'm risking much less money. I mean, I don't get it. So if I had just bought the puts at 620, okay, so if I bought 3 puts at 620, Vic, and assuming everything worked out well, I'm risking $1,860. I know, I'm telling you. I would have risked $1,860 this way, with time decaying fast, right? So if we're at 59.60, they're going to expire worthless. Or you play for the spread. So I bought them at 315, 3 times 315. I put up $945 and ended up making $255 versus the other one. If I had bought those puts 620 to 765, I would have made 500. So let's look at the numbers. So 620 to 765 is 145 times 3, about $445. I would have put $2,000 just about to make 445, but with time decay costing me a lot more, right? I mean, you could do that. You could trade those 0 DTE puts for sure. But I like the spreads because I have MVC numbers. Like this morning when the market opened, MVC was 5,600. And then, 59.10 or 59.15, I think. And we sure bounced from all the way to 58.95 to 59.15 and went higher, and MVC kept going higher. So When MVC is moving, market's going to end up at MVC. Once market gets to MVC, there is no more reason for the market makers to move the market. So those are the reasons I kind of look at. Once in a while I do it. I think, you know, we may sell off at the end of the day, or we may whatever, but I don't know. I usually like doing the debit spread, or put debit spreads or call debit spreads. Limited risk, risking 2.5, 3 to make 10. That's the way I look at it. I mean, you know, I could buy the 0 DTE puts. I could day trade those, obviously, or calls. That's all I'm saying. So, okay, let's see. 3 times 315. I put up 900. Let's see what kind of return that is. It's pretty similar return with less risk. Let's see. I put up 315 times 315 times 3. I put up 945 and ended up making 85 times 3, 255. So 255 divided by 945. So I made 27%. Versus, then I would have bought them at 620. 620 times 3. I would have put 1,860. And let's assume I got out at 765. 1.45 times 3. I would have made 435. 435 divided by 1860 is 23.3%. See? The other one was 27%. So 4% more with less risk. I hope I can explain. I hope I could explain it to you. I hope I did. I don't know. I like these because market makers will pin the market at 59.55 probably today, and that's where exactly we're at 59.58 now. And that's how I pick my wings, 59.60, 59.55. And that's what it is. That's why I did it. Any other questions? No? Okay. That it totally has become a nothing burger day. This rally was amazing. Yeah. I mean, if you had puts, imagine that. You're kind of feeling sorry at the moment. You had your chance. This is what the market does. You know, it gives you a little chance and then bye-bye chance. Is worst case TLT 80? Yeah, I don't want to see it at 80. I have short 85 puts. Possibly 80, 81. Yeah, somewhere in that range. At 80, 81, we're looking at 5.25%. I don't think the market's going to ignore 5.25%. And that was one of the reasons the market didn't ignore it this morning at the open. Then we kind of, you know, rallied. The bonds rallied from 84.5 to 85.70, 85.80. That's a huge move for bonds. And that's why we bounced. So, yeah. All right. Let's take one more look. Yeah, we're selling off actually now. 59.57. We probably could have sold those at 4.5 probably. Let's see where they are. 59.60. Let's see. Oh, they're still at 4. So see, time decay is kind of getting to it. Yeah. Now the other thing I can do now is do a put credit spread, because I don't think the market's going to tank. Let's see, right at WeWap 59.45. Yeah, we could do that 5 wide. Let's see where that put credit spread is. This time we're selling the 59.45 and buying the 59.40, 75-cent credit. We're at 59.57. That's too close, bro. We can go 10 wide and go to 59.30. There's still 2 hours to go. That's a lifetime. Market sells off, you're dead, max loss. That's why I don't like doing put credit spreads as much as I used to. But yeah, that's the reason. Put credit spreads were good probably at the open this morning. Not now. We're right at 59.55, folks. We're right at NBC. Now they're going to watch paint dry for the rest of the day, or let's see where NBC goes, because gamma exposure has been met and there's no more reason for the market maker to do anything else. And we'll see. We'll see where we go from here. So maybe I'll pull another trade. If we pull to 59.45, I'll do a call debit spread with 0 DTEs with a couple hours, well, maybe an hour to go. And that should be the last trade. So it's all good. All right, positions 378 on EVgo, no problem. Puts are fine. Yeah, we're okay. Yeah, no problem. Kind of ho-hum day. Made a couple $100 while you guys were watching. $250. That pays for lunch. It's not too bad. And we probably could have sold them now. Let's see. See, the market's lower, but I'll bet I wouldn't be able to sell it for much higher, other than 4. Yeah, when these move, you got to take quick profits on these. They're 810, 820. So sell, buy. They're 430 now, 440. So I could have taken another 40, 50 cents, but I have, yeah, they're 450 now. So I could have taken another $150. Yeah, it's all good. Yeah, 435. Gotta take quick profits. You know, if you can take $250 out of the market every day, that's another $5K a month. Every day you have to be right. What are the odds of that? Not too much. But, you know, limited risk. Even if you have a small account, you can do that. I don't know if Robinhood lets you guys do that. I have Thinkorswim. I like the platform. It's pretty good executions, actually. And commissions are pretty damn low. So, yeah, that's where we are. Go back to charts. Flexible. Let's see if there's more question. Call debit? No, at WeWap 59.45. Maybe I'll do a call debit spread, yeah, with 0 DTs. You know, a couple 3 contracts. I'm trying to understand if I can add that to my toolbox, because NBC market definitely gravitates towards NBC. And when you look at gamma exposure and delta exposure, you have a pretty good idea where the market's going to end up. And if you're like really far away, if you're under it, buy a call debit spread. If you're way above it, buy a put debit spread. And most of the time, most days, we're going to end up at MVC. When I say MVC, is MVC, most valuable contract. That's where it's not the same as max pain. So you guys must understand that. But okay, I'm going to say goodbye, and we'll see you. We'll see the members on Wednesday, and we'll see all of you on Friday for Power Hour. Next Monday is Labor Day, I think, right? Oh, Memorial Day, sorry. Markets are closed, so I probably won't do the show, or maybe I'll do the show, have you all come on. 59.69, 59. No, I wouldn't do it here. No, I mean, if you want to do it, but I wouldn't do it. I think NBC is 59.55. So they're going to expire worthless, both sides. I wouldn't do it. Yeah, we'll see. 2 hours to go. Long way to go. We'll figure that out. I'll put it on the chat, Luis, if I do it. Members on the chat. Yep. Okay. I'm going to say goodbye. Go have a cup of coffee. Chill out. Do some other work. See you guys on Friday for Power Hour. Bye now.